Welcome to the Deep Dive. Today, we're taking on a mission, really. We're comparing two investment vehicles that, look pretty similar on the surface. That's the Vanguard Total Stock Market ETF, VTI, and the iShares Bitcoin Trust, IBIT.
Right.
Both are called ETFs. Both trade publicly. But trust us, that shared label, it's basically the ultimate red herring here.
Yeah, it really is.
We're going to dig into why the differences are just way more profound than any similarities.
And that's the fascinating part, isn't it? How that common ETF wrapper can, mask so much.
Exactly.
We're going to peel back the layers, look at the legal bones, how they actually work day to day, and really importantly, the risk involved.
Crucial stuff for you, the listener, to understand what you're actually holding.
Absolutely. You need to know what's under the hood.
So where should we kick off this deep dive? How about we start right at the foundations, the legal structure?
Good place to start. Very different foundations.
Okay, so VTI, this is like the meat and potatoes of investing for a lot of people.
Yeah, a core holding, yeah.
It's a classic, passively managed fund. Tracks the entire U.S. stock market, over 3,500 stocks.
That's right, the CRSP U.S. Total Market Index. Very broad.
And the cost is tiny, 0.03% expense ratio. Plus, it's built on the Investment Company Act of 1940.
The 40 Act. Rock solid, decades of established rules, investor protections built in.
Okay, so that's VTI, established, broad, cheap, 40 Act regulated. Now, IBIT.
Totally different world. IBIT operates as a Delaware statutory grantor trust.
Okay, unpack that. What does grantor trust actually mean for an investor?
It's a fundamental difference. Think of it less like a managed fund company and more like a structure that lets you, the investor, sort of technically own the underlying asset directly.
Which in this case is Bitcoin.
Exactly. Almost entirely Bitcoin, held directly. It's a clever workaround, really. A regulatory adaptation to fit this new digital commodity into the old financial system without using the 40 Act framework.
So no 40 Act registration for IBIT.
Nope. And that immediately raises questions about, the stability, the specific investor protections compared to something like VTI.
Right. And you said it holds spot Bitcoin, meaning actual Bitcoin, not futures contracts or anything.
Correct. Direct exposure to the price of Bitcoin itself. And that legal difference, the grantor trust versus the 40 Act fund, it really sets the stage for everything else.
Like the risk.
Especially the risk and how you'd use it in a portfolio.
Yeah, let's talk risk. VTI is rated, moderate? Like a 4 out of 10?
Something like that, yeah. It's designed to be a core holding, broad diversification, long-term view. It moves with the market, basically.
Okay, now IBIT.
Whoa, different league entirely. Highly speculative. I mean, the prospectus literally warns about the risk of total loss.
So it's a loss. It's stark.
It is. It tells you this isn't your foundational piece. It's for a high-risk allocation, maybe a satellite holding, for people who specifically want Bitcoin exposure and understand the massive volatility.
So we're talking fundamentally different assets underneath, despite the similar ETF wrapper. One's thousands of U.S. companies. The other is a single digital commodity known for huge price swings.
Precisely. VTI is the diversified family sedan. IBIT is maybe more like a rocket ship. Sometimes it goes up fast, sometimes. Okay,
so definitely not comparable for the average investor building a core portfolio.
Not for the core, no, but it does fill a niche. If you have a high-risk tolerance and want regulated Bitcoin exposure without dealing with wallets and keys, IBIT makes that accessible.
Got it.
Yeah.
Now, what about how they operate, the mechanics? You mentioned the in-kind creation-redemption process for traditional ETFs like VTI.
Right. That's key for tax efficiency in VTI. The fund managers can swap baskets of stocks for ETF shares and vice versa without usually having to sell the stocks within the fund.
Which avoids triggering capital gains inside the fund that would get passed on to shareholders.
Exactly. It's a huge benefit.
Yeah.
Now, Bitcoin ETFs initially couldn't do this. They were cash create or deem only.
And that changed recently, right? That was big news.
Huge news. The SEC approved in-kind redemptions for spot Bitcoin ETFs like IBIT. That was a landmark moment.
Why was it so significant?
Well, it brings IBIT's plumbing much closer to VTI's. It makes the whole process potentially more efficient, tighter spreads maybe, better tax outcomes potentially, aligns it more with how traditional ETFs work.
Yeah.
It's a real signal of institutionalization, of crypto becoming more integrated.
Okay, so the vehicle operates more smoothly now, more like a traditional ETF.
Yes, the operational mechanics are converging.
But does that change the risk of holding Bitcoin itself? If Bitcoin's price drops 50%, the in-kind redemption doesn't help you there, right?
Absolutely not. That's the critical point. It improves the wrapper, the delivery mechanism. It makes the ETF vehicle itself work better. But the underlying asset, Bitcoin, remains just as volatile. It doesn't change the total loss risk one bit.
So, better plumbing. Same risky cargo.
That's a good way to put it.
Okay, let's touch on taxes explicitly then.
Yeah.
VTI, as you said, very tax efficient because of that in-kind process limiting internal capital gains.
Right. You mostly just worry about capital gains when you sell your VTI shares.
And IBIT, with the grantor trust structure.
You're taxed essentially as if you owned the Bitcoin directly. When you sell your IBIT shares, you report capital gains or losses based on Bitcoin's price movement. There are no dividends or interest generated by Bitcoin itself, so none pass through the fund.
So different tax profiles, too. It really comes down to suitability, doesn't it?
Completely. VTI. Broad market, long-term core, tax-efficient wealth building. IBIT. High risk tolerance, specific Bitcoin exposure desire, understanding the speculative nature and tax implications.
So pulling it all together. What's the main takeaway for you listening? That ETF label, well, it really hides more than it reveals here.
It absolutely does. You've got profound differences in the legal structure, the underlying assets, the risk level, the portfolio role, even the tax treatment.
It's a perfect example of needing to look beyond the name.
So the bottom line, for that foundational, diversified, long-term core part of your portfolio, VTI or something like it, is still clearly the standard choice.
Makes sense.
IBIT, though, it definitely serves a purpose. It offers a convenient, regulated on-ramp for Bitcoin exposure within a traditional brokerage account, but strictly for that speculative, high-risk slice of a portfolio. Use it, with eyes wide open about what it is and what it isn't.
Understand its role.
Precisely.
Yeah.
And maybe a final thought to chew on.
Yeah.
This whole process, the institutionalization of Bitcoin through products like IBIT, the trading, the arbitrage, it's not just creating new ways to invest. It's actively changing Bitcoin itself.
How so?
It's influencing its market structure, how prices are discovered, who the marginal buyer or seller is. It ties Bitcoin more tightly into the traditional financial system. So the question really becomes, how will this ongoing evolution, the regulatory changes, the big institutions moving in, how will that continue to shape what Bitcoin is and how it behaves in the future?
That is something to think about, the product shaping the underlying asset. Fascinating.